If you plan on moving in retirement, or even if you think it's a possibility, now is the time to start planning for taxes. Otherwise, it could end up costing you tens of thousands of dollars or more in retirement. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and today we are talking about taxes, specifically around moving and why this is important. A lot of people go throughout their life and think, hey, I will move closer to my kids or to my grandkids at some point, and they're not proactively thinking about what will the tax picture look like in that new state. And why this is important is each state taxes income differently. For example, where I'm from, Washington State, there's no income tax, but a few years ago, a capital gains tax was passed. It has a pretty high exemption amount, so a lot of people don't fall into needing to pay that tax, but for other people, they might. There are other states like California that traditionally have a pretty high tax burden, and then there are other states such as Pennsylvania, for example, that doesn't tax retirement distributions. And this is really important to know how states tax this income, because on a federal level, we can more or less plan around that. But from a state level, there's some strategies that we can take either before moving or shortly after moving to recognize income. So let's dive into an example. Let's say that you are currently living in Illinois, which has an income tax. But interestingly enough though, Illinois doesn't tax retirement distributions. It also doesn't tax Roth conversions because that's considered a retirement distribution. So let's say you're living in Illinois and you plan on living there for the next few years or maybe a decade, and then you want to move back to the West Coast. Let's say you're from there originally, you have family there or grandkids that you want to grow up around, and they live in Oregon. Oregon has a pretty high tax burden as a state as well. Their tax bracket ranges from 4.75% up to 9.9%. Now, you may be thinking 4.75, not too bad, which for most states, that's correct. Unfortunately, the brackets are very narrow. So what ends up happening is pretty much any income above around $10,000 starts getting taxed to 8.75% up to a little over $100,000, about 125 more specifically. So that's important to know, because if you're taking a retirement distribution, let's say you've built up a really large IRA balance, and now you need to start taking required minimum distributions or just income for general spending, and you need to distribute, say, $50,000 or $100,000, that's on top of Social Security, pension, other investment income, you may quickly approach paying that 8.75%, or you may get bumped up into that bracket at 9.9%. So if you're that person living in Illinois today, and you know in the future, hey, I am most likely moving back to be closer to grandkids, you have an opportunity potentially in Illinois to do Roth conversions. Now you can play around with federal taxes and do some tax projections to see, hey, am I falling in the 22% tax bracket, 24, do I want to go up to the 32% tax bracket? You have options there, but you need to consider the state tax. So in Illinois, if you're paying 0% on these Roth conversions, but you know at some point, this IRA balance when I move to Oregon is going to be taxed, and let's just say it has an average rate of 8.75%, there's a change there where you may want to consider doing Roth conversions in Illinois. For example, let's say you have $1 million IRA and you could fully convert that while in Illinois. I'm not making that recommendation. You'll want to talk to a tax professional, but let's just say you could, and you could do that tax efficiently from a federal level, and it doesn't increase your Social Security taxes. And there's a lot of other things that you'll want to consider here, but let's just say for simplicity here, you can do Roth conversions, a series of them over a few years, and stay within that 22 or 24% tax bracket. You're comfortable paying that because you anticipate paying that for the rest of your life, given your other income sources, but you get to skip the 0% Illinois tax bracket. And while you're doing those Roth conversions, you're not paying any Illinois income state tax for that Roth conversion. Then when you move back to Oregon, you now have a Roth IRA. Let's say you converted the full $1 million, it's probably $1 million plus at that point. You're not taking those distributions. You've essentially skipped or avoided having to pay that 8.75% in this scenario. So $1 million, you're saving over $87,000 in taxes. Whereas if you did nothing, let's say you just were living in Illinois, you didn't do any sort of proactive tax planning here, and you just moved back to Oregon, then you had to start taking distributions, and over your life, you fully distribute the $1 million. And I recognize there'll be some growth on that, and it could be a different value, but just for simplicity here, let's assume it stays at $1 million. You fully distribute that, and say the average rate is 8.75%. You've paid $87,000 in taxes to Oregon that you wouldn't have necessarily need to pay had you done those Roth conversions. So this shows the power of how different states tax income and how if you're planning on moving, you want to do some proactive tax planning. And this isn't a, hey, I'm moving next year, let's do some tax planning now. Obviously that would be better than nothing, but this is, hey, what do I want in my life? And this is why I have a lot of conversations about what isn't in your ideal life and what do we anticipate happening, so we can plan around things like taxes or estate planning or investments to make sure that we're trying to pay the least amount of tax as possible to allow you to have that money to go out and live your ideal life. There are many other examples of how different states tax different levels of income and planning around that. This is just one hypothetical scenario. As you go down the list of states that don't have any income tax: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming, New Hampshire. Again, an asterisk on Washington just because they do have a capital gains tax, but many people are not paying that because of the high exemption amount. And then you have some nuances with pensions and retirement distributions generally not being taxable. Again, consult your tax professional, but that being Illinois, which we talked about today, Mississippi, Pennsylvania, and Iowa. And there are many other different examples like this. So this is where you want to work with an accountant or be very familiar with how your state taxes this and what state you're moving to and how they see that. I hope you have found this helpful using a hypothetical scenario that could be happening in the real world of how you can proactively plan for taxes and how it can literally save you tens of thousands of dollars, if not more, in taxes. Tax planning is a really important part of retirement, and you need to make sure that you're on top of that. If you found this video helpful, click that subscribe button so you can be notified of future videos. Thanks for watching.